Hello, everybody, and welcome to another episode. I sure hope your day is going better than mine. So, in today's episode, we're going to be talking about three stocks I'm buying, December edition. We're doing a whole lot of things differently today. I first thought it would be fun to go over my portfolio. It'll kind of give you some context as to why I'm buying some of the stocks that I am. And, I just figured it would be fun to be open and share with you guys. So, as you can see, I have a very concentrated portfolio. Currently have like about 37, 38% stake in AMD and Google's 22%. We have a very high Ceragon, which is a speculative position. We also have a lot of money in SoFi. Uh, then Cheesecake Factory, Salesforce, and Wirehouser are all very small positions. We're working on those. We'll get to them. No spoilers. So, um, we're doing everything differently. I'm in my room. This is the second take. I ruined the first take by not adding the display capture. Um, it is currently 11:40 and I have to work tomorrow. I've been working on this presentation for 3 days and I really want to get it out before Salesforce reports earnings tomorrow. So we're gonna kind of rush through this. Please bear with me. I really appreciate you guys. A gentle reminder: if you could please like, comment, subscribe. Really tell me how I'm doing. Let me know if I'm providing the content that you want to watch, because that is ultimately my goal. I want you guys to be excited to watch me. I want you to like what I provide. Um, so yeah, just let me know how you feel. If you could please hit the thumbs up button, that helps me out a ton. And if you subscribe, you'll be able to see my future videos whenever they come out. So, before we get into the three, we have some honorable mentions. Hi, Kitty. AMD and Ceragon both are very high concentration for me, but I really like both of them where they're at right now. AMD's kind of gone up a little bit. If we could get it under 200, that would be amazing, but it's still a buy today. And Ceragon, especially at that $2 mark, is a fantastic buy. I know I've released a couple of videos on it. I actually do have some more research. If you'd be interested in knowing the exact reason why I'm so willing to kind of ignore the decline in India revenue, I can go over that in detail. Again, just let me know what you want to see from me in the comments below. So, the first stock on our list, and I really should have put this in slideshow mode. Salesforce! Alright, why are we buying Salesforce? So, Salesforce kind of goes in the same camp as AMD and Google over like the past year. It has been plagued by a negative Wall Street narrative and general sentiment. Similarly to when AMD investors bought everything, or like overbought the stock about a year early, we're kind of seeing the same thing with Salesforce. I really expect Salesforce to kind of have all of those expected um, outcomes kind of materialize over the next couple of years with Agentforce and AI and all that. I also just really don't buy the AI is going to ruin software narrative. It kind of seems really silly to me. Um, but yeah, no, as you can see below, Salesforce is down 30% over the past year and is over the past 5 years down 6%. So it's been really beaten up, but I think the next couple of years are really where the stock will shine. So, as of the quarter three earnings report tomorrow. Again, I've been working on this since Saturday. So if you want for further confirmation, you'll probably be able to see those before you see this video anyway. Um, but of course, if anything changes there, I'll definitely upload another video and kind of highlight that. Um, Anyway, originally I said if you want to wait until Wednesday to get further confirmation, you're welcome to, but we have already gotten the confirmation that they are seeing a real return on investment off of the Agent Force and AI. In the quarter two earnings, the company reported Data Cloud and AI annual recurring revenue jumped 120% year over year to 1.2 billion. The company also cited specific success in customer adoption and expansion. So, the launch of Agent Force, or since the launch of Agent Force, the company has closed 12,500 deals, with 6,000 of those already generating paid revenue. 40% of Agent Force bookings in quarter two were from existing customer expansions. So basically, they're selling more to their current customers, which is fantastic. And there was a 60% increase quarter over quarter in customers moving from pilot to full production. So that all seems fantastic to me. If you need more proof that they are delivering on Agent Force and AI, then be my guest. But that's pretty conclusive, in my opinion. And again, unless the quarter three reports show significant deterioration of this progress, any dip in the stock after earnings is just going to be a buying opportunity. So I'm going to go over my 4-year projection for Salesforce with you. The projection involves a few components. I really should have updated that since this is the second take. It's a 10.5 net income growth rate, driven by 10% revenue re-acceleration from AI and Agent Force, and approximately a 0.5% operating margin expansion. So 0.5%. We're also including about a 3.5% reduction in share float. This is a conservative estimate based on the authorized $50 billion buyback program as of quarter two. We'll find out tomorrow how much of that they've actually deployed. I'm hoping to get some really good news there. Anyway, this results in a 15.5% earnings per share compound annual growth rate, which is what we use for our base case. So we're going to start with the base case, that 15.5%. That'll put our 2030 earnings per share at $20.22. We're going to use a price to earnings multiple range of 24 to 27, and that will give our 2030 price range of 485 to 545. That will, assuming this all plays out, that implies a compound annual growth rate of 17.4 to 21%. That is phenomenal. Absolutely outstanding. For the bear case, if things go wrong, I actually cut the earnings per share compound annual growth rate all the way down to 8, so that's nearly half of the growth rate, guys. That puts our earnings per share in 2030 at 15.46, and we're using a range of 20 to 24, which is really low. Even if they were only growing 8%, that seems like killer. But that would put us at a share price in 2030 of 309 to 370. That implies a compound annual growth rate on the low end of 4.9% and on the high end of 9.8%. Bear case, still making about market return, is exactly what we want to see. I love it. For the bull case, I put their earnings per share compound annual growth rate all the way up to 19. The reason I set it so high is because, like I said before, the 3.5% reduction in the share float was a conservative estimate. So this allows for some surprise, or let's say they really aggressively bought back shares over the next couple of years. We might hit that range. Anyway, that'll put our earnings per share rate in 2030 at 22.78. We're going to use an earnings per share multiple of 26 to 30x. That is going to put our 2030 price range between, on the low end, 592, and on the high end, 683. That'll give us a compound annual growth rate of, on the low end, 23.5, on the higher end, 27.9. That is just an outstanding return. If every investment I got was that high, I don't even know what I would do with myself. That would be beyond amazing. What? Hold up. We skipped a slide. So sorry about this, guys. Okay, so for the investment thesis, it's really important that I specify that the idea is that the market is currently mispricing its true operational efficiency and cash generating power. To accurately model this opportunity, we must look at the company's non-GAAP earning per share figures. If you thought my numbers were a little wonky, that's why. We're using the non-GAAP. Why the non-GAAP? So, the official GAAP earnings per share is significantly lower because it includes massive non-cash expenses, primarily stock-based compensation, while SBC is a real cost of doing business and a negative impact to shareholders. Our thesis relies on management successfully mitigating that cost by using their enormous free cash flow to buy back ample shares. Therefore, the non-GAAP earnings per share reflects the true cash flow available to fund growth and fund those aggressive buybacks, which act as the financial multiplier for our projected 15.5 earnings per share growth rate. Ultimately, the goal of making a projection is to assume what Wall Street will be paying for the stock, since they actually have the ability to affect share price. And in order to do that, we really should be using the same inputs that they will use. So I'm going to have you follow me over to the next slide, where we use logic to justify my decision and to kind of prove that they are using the non-GAAP numbers. So my proof. Stick with me. This is a lot. So, the average 1-year target consensus on Salesforce is going to put the stock price in 2027 at 328.85. In order to get this calculation, we need two inputs. We need the earnings per share and we need the multiple. So, we're going to start off with the non-GAAP consensus estimates. The non-GAAP estimates would put the earnings per share 1 year out at 12.71, reflecting a 12% earnings per share growth rate. We can use this to divide the 328 by the 12.71 to get approximately a 26 price to earnings, which is a very reasonable multiple, right? Well, let's check the GAAP earnings per share. And I'm just going to let you know in advance, I kind of fudged the numbers, but I did it to really prove a point. So, if we use the GAAP earnings per share, and we use my inflated growth rate of 15.5, that'll put the 2027 earnings per share at 7.94. This implies a price to earnings of about 41 times, which again is actually lower than it should be because we used my higher growth number rather than the 12 that they would use. So If we compare those two, we can now kind of make a reasonable assumption of what the analyst thought process is, right? It's a whole lot more likely that they're using the current price to earn, or that they're assuming the current price to earnings of approximately 22 will increase to approximately 26, and the non-GAAP EPS will grow about 12% to 12.71. That, like, if we were to, that sentence makes a whole lot more sense than the analysts are assuming that the stock's multiple will increase from a 34x to a 41x, and the earnings per share will increase more than they assumed at 12% to a 15.5%, all the way to 7.94, right? So hopefully you stuck with me. Hopefully you agree. If you don't, that's fine. The the projections look a whole lot worse when we use the GAAP earnings per share. But again, the goal is to find out what Wall Street is going to be paying, and that is the closest that I could get. Stock number 2 that I'm going to be buying in December is Weyerhaeuser. I'm really hoping that this is a new one for you. I started researching this stock early November, and the more I learn about it, the more I like it. I'm starting to get more and more excited. Weyerhaeuser is one of the largest timberland companies in the world. They own nearly 12,400,000 acres in the U.S., and they have long-term licenses to operate on 14 million acres in Canada. Lumber is necessary for the homes we live in and the furniture that we place in it. The stock is highly cyclical, and it, for the most part, follows the, well, directly it follows the price of lumber, which roughly follows the housing market. So again, being highly cyclical, I'm kind of calling that now we're currently at, or at least very near, the bottom of that cycle. And as rates fall, the housing market should increase, at least theoretically. The activity in the housing market should increase. And that will ultimately lead to building permits and houses being built increasing, which will increase the demand and therefore the price of lumber. So Weyerhaeuser is structured like a REIT, where the company aims to disperse 75 to 80% of their funds available for distribution. We're going to kind of conflate AFFO and funds available for distribution, just kind of for simplicity's sake. But basically, because they're a REIT, the multiple we're going to be using is priced to adjusted funds from operations, or the funds available for distribution. Anyway, like I kind of mentioned in the previous slide, the sensitivity factor is, ha 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 ha, I got ahead of myself. This is the sensitivity scale that I used using Google's help. The sensitivity factor is the price of lumber. So effectively, for every $10 increase in lumber, the company gets approximately a $45 million increase to their EBITDA, or roughly 5 cents funds available for distribution per share. So the current price of lumber is right around that 540. That's going to be at the bottom of our range. And if we look at the multiple, that kind of aligns pretty well with where the stock price is sitting at now. The whole theory behind this is we can kind of model what the stock price should be based on the price of lumber. So that's how this chart reads. If lumber were to recover, it would go to about $640. That would increase our funds available for distribution by about 50 cents per share, which would increase the target price using a price to adjusted funds from operations between 22 and 25, which is normal for a REIT, would set us at $28.16 on the low end to $32 on the high end. The whole theory is that the housing market is going to become reinvigorated with rate cuts. One of my favorite YouTubers, Financial Education, or Jeremy, very frequently goes over um, the home builders like Toll Brothers and the furniture companies. This is my play on it. It has a very high alpha, and hoping that I'm catching it at the bottom. Either way, it'll be a income play, and hopefully, if I'm right, we'll see some great appreciation with it as well. So it's not just buying the 3%, dividend. That was a really short crash course, and my energy is dying. The second take is a whole lot slower. So if you would like a video going over my comprehensive research, going over everything about the stock, it's all done. I would need to write it up. But again, just put that in the comments down below. I'll get to that if that's something that you'd be interested in seeing. Anyway, on to stock number 3 that I'm buying for December. That's going to be the Cheesecake Factory cake. So, here's another stock that's really been beaten down recently, mostly because Wall Street doesn't want to own restaurants, and their consumers been kind of weak with all of the government shutdown and everything. But one, consumer is not going to be weak forever, and two, we are long-term investors, and um, I don't really care what happens over the next couple months. Um, Cheesecake Factory is one of the most exciting stocks if we're looking out for the next 5 to 10 years out of almost any other company that I can find, aside from real micro caps, right? um, with North Italia and Flower Child expanding all across the U.S., they're just everything lining up is so exciting. Anyway, so they have those 3 concepts, and then they are testing out several other concepts. When I say testing, they're more trying to determine whether they should go nationwide with them or if they should just keep it to concentrated markets like big cities. But I live in Phoenix, and I get to test out all of these concepts, and I gotta say they're amazing. I wanted to kind of just show you all of these restaurants. I've visited all of them. I've eaten at 3 of them anyway. So Blanco is their Mexican concept. By the way, this plaza is gorgeous. On that side, there is a North Italia, and on that side, there's a Flower Child. There's this great big grass field, and it's right next to ASU Stadium. My son was just running around in the grass while we were having dinner. It was fantastic. Great, love it. I love it. Culinary Dropout again. I think there's actually 2 or 3 of them in the area. I've eaten at 2 of them. They were both run about equally well. They were both so packed that we had to park like a couple blocks away and walk. And it's just fantastic. It's run really well. They're all Blanco, Culinary Dropout, and Doughbird are, every time I drive by them, just absolutely packed. Doughbird is their pizza concept. It's like you can see on the, right here, it's a pizza and rotisserie. But they actually do delivery. All of the cake restaurants are partnered with DoorDash, but Doughbird specifically does delivery for the Scottsdale area that I live in, and it's amazing to be eating dinner, having everything so packed. People are waiting outside to get seated, and they're delivering pizzas every 3 to 5 minutes. Another pizza goes out. amazing how busy all of these restaurants are, and it just really kind of reinforces my idea that this is going to be a fantastic investment. The Henry, this one I have not eaten at, but I visited, and same with the Arrogant Butcher. Anyway, so Cheesecake Factory, as of Q3, they have opened 19 new restaurants this year. They are scheduled to open 6 more in Q4. The company has 26 openings planned for 2026, and the same store sales in these new restaurants are ramping up very effectively. Flower Child's growing same-store sales at approximately 31% on on average, and North Italia is growing about 16% on average. Assuming these trends continue as the consumer strengthens, it's actually more likely that they're going to accelerate. But assuming they continue, they'll very quickly begin to contribute in a very meaningful way to top line. This will kind of just snowball, ultimately justifying a higher valuation multiple because their revenue just keeps accelerating and accelerating and accelerating, right? So you can see how things can get out of hand and go, how they can get out of hand really quickly. Um, Recent market drama has pushed the stock down from its 52-week highs. It's sitting at a very modest trailing PE of 14, and the forward PE is 12. Um, Again, this is just really providing a buying opportunity. I'm adding very steadily to my position, and I'll be buying this probably for years. It's just such an amazing opportunity. Anyway, guys, that's going to be it. Thank you. Seriously, if you're still here, please let me know down in the comments. I applaud you. Thank you so much for putting up with me. I'm very clearly very tired. um, and if you're still around, really, please do hit the like button. Comment down below. Let me know what I'm doing right, what you want to see. And also hit the subscribe button so you can, be notified of my future videos. I really hope to see you in the next one. That's going to be all, and I really hope you have a great rest of your day, guys. I'll see you next time.